You have been told that investing is gambling, that it is complicated, that it is something for rich people, for finance bros, for someone older, smarter, and richer than you. And that story, the one that keeps you frozen on the sidelines, is quietly the most expensive story you will ever believe. Because here is what nobody tells you. You are already investing. Every single day. The only question is who you are investing for. The cash sitting in your bank account is not resting. The bank is lending it out, earning real money on it, and handing you almost nothing back. Your money is already in the game. It is just playing for the other team. In the next few minutes, I am going to show you what investing actually is, stripped of the myths and the jargon. The one number that makes starting early matter more than starting big. The exact order to put your money in so you never leave free money on the table. How much you should actually invest. And the 20-minute setup that turns you from a saver into an owner. Stick around, because the biggest risk here is not the one you have been taught to fear. It is the one hiding in plain sight. Let me tell you exactly who this is for. This is not a hot stock tip. This is not about timing the market, day trading, or turning $1,000 into $1 million by Friday. If anyone promises you that, run and take your wallet with you. This is about the boring, proven, almost embarrassingly simple way that ordinary people have quietly built real wealth for decades. Teachers, nurses, mechanics, people who never earned a huge salary, but who started early and stayed consistent. If you have a little money left over after your bills, if you have your emergency fund started, and you have been staring at the word investing feeling like it is a locked door with no key, this video is the key. And one honest note before we go further. This is general education, not personal financial advice. I do not know your income, your debts, or your goals. So take the math and the framework and run your own numbers for your own life. Here is the map of where we are going. First, why not investing is the real gamble. Then what a stock and an index fund actually are, in plain English. Then the one number that does all the heavy lifting. Then the exact order to invest in and how much. And finally, how to start today, plus the mistakes that quietly kill returns for almost everyone. Let us begin with the risk nobody warns you about. Here is the part nobody says out loud. Keeping all of your money in cash is not the safe choice. It just feels safe. Because there is a silent tax on every dollar you do not invest, and its name is inflation. Prices rise a little every year, historically somewhere around 3% on average. That means the money in your account does not just sit still. It slowly loses power. $10,000 kept as cash today buys noticeably less in 10 years, and roughly half as much in 25. You did not lose a single dollar on paper. Your balance looks the same, or even a little higher. But you quietly lost it in what those dollars can actually buy. A candy bar that cost a nickel decades ago now costs well over $1. That is not the candy getting greedy. That is your dollar shrinking. So the person who keeps everything in cash to avoid risk is not avoiding risk at all. They have chosen the one outcome that is almost guaranteed to lose, slowly, quietly, every single year. Meanwhile, the stock market, the thing you were told to fear, has done the opposite over long stretches. Yes, it drops. Sometimes it drops hard, and the headlines scream that the world is ending. But zoom out, and every 20-year period in modern history has ended higher than it started. Let that sink in. The scary option has never once lost money over 20 years. The safe option loses a little every year, guaranteed. Once you truly see that, the whole question flips. It is no longer, can I afford to invest? It becomes, can I possibly afford not to? So what is investing actually? Forget everything the movies taught you. Forget the guy in a suit screaming into two phones on a trading floor. At its core, investing just means owning a piece of something that grows over time. When you buy a stock, you are not gambling on a random number. You are buying a tiny slice of a real company. If that company earns more, serves more customers, and grows over the years, your little slice becomes worth more. That is it. You become a part owner of a business without doing any of the work, going to any meetings, or answering a single email. Now, picking one single company is genuinely risky. because any one business can stumble or fail. Betting everything on one stock is how people get burned, and it is what most people picture when they hear the word investing. But this is where the single most important invention in personal finance comes in: the index fund. An index fund is not one stock. It is one basket that automatically holds a tiny piece of hundreds or even thousands of companies at the same time. When you buy a fund that tracks the whole US market, you are not betting on one company surviving. You are buying a sliver of the entire American economy, all the household names you already hand your money to every single day. If a few companies fail, the winners more than carry them, because that is how the whole index is built. You are no longer trying to find the one needle in the haystack. You are calmly buying the entire haystack. And because a simple computer just holds the index, instead of a highly paid manager guessing and trading, the cost is almost nothing. That is the quiet genius of it. Boring, diversified, and cheap beats exciting and expensive almost every single time. Now here is the number that changes everything. Historically, the broad US stock market has returned around 10% per year on average before inflation over the long run. After inflation, call it around 7%. Some years are wildly up, some are painfully down, but that is the long-term average once you smooth it all out. And when you leave money invested, something that feels almost magical happens. Your gains start earning gains of their own. That is compounding, and it is the closest thing to free money that exists on this planet. Here is a simple way to feel it. At around a 10% return, your money roughly doubles about every 7 years. So $1 becomes 2 in 7 years, 4 in 14, 8 in 21, and 16 in 28. It does not grow in a straight line. It grows like a snowball rolling downhill, slow at first, then enormous. Let me make it real. $10,000 left in a plain market index fund back in 2006 would have grown to roughly $67,000 by 2025, with dividends reinvested, and that includes living through one of the worst crashes in history along the way. You did nothing but wait and hold. But here is the part that should light a fire under you. The engine of compounding is not how much you invest. It is how long you let it run. Because the last few years of growth are always the biggest by far. A dollar invested at 25 has decades to multiply. The same dollar invested at 40 misses the most powerful stretch entirely. This is exactly why waiting is so quietly expensive. Picture two people who invest the exact same amount each month. One starts at 25, the other waits until 35. That 10-year head start can be worth hundreds of thousands of dollars by retirement, even though the early starter only put in a little more of their own money. Tom did almost all of the work, which means the best day to start was years ago. The second best day, the only one you actually control, is today, with whatever amount you have. But not every dollar should go to the same place, and getting the order right is worth a small fortune. Think of it as a staircase you climb one step at a time. Step 1, before you invest a single cent, is your foundation. Pay off any high-interest debt, especially credit cards. No investment reliably beats a guaranteed 23%, so wiping out that debt is genuinely the best, safest return you will ever get. And keep your emergency fund in place, sitting in a high-yield savings account, so that one bad month never forces you to sell your investments at the worst possible time. Step 2 is the single most important step, and it is the one most people skip without realizing what they are throwing away. If your job offers a retirement match, take it first, before anything else. A match means your employer puts in free money whenever you do. If they match your contributions up to a certain limit, that is an instant, guaranteed 100% return on your money before it has even started to grow. Turning down a full match is like being handed part of your paycheck and saying, "No thanks, keep it." Take every single cent of it. Step 3, after you have captured the full match, is a Roth retirement account. In a Roth, you invest money you have already paid tax on, and then it grows and comes out completely tax-free in retirement. In 2026, you can put in up to $7,500 a year. Decades of totally tax-free growth is one of the best deals the system quietly offers to ordinary people. And step 4, once the match and the Roth are handled, is a regular brokerage account for anything extra you want to invest. So the order is simple. Match first, then Roth, then brokerage. Follow that exact order, and you capture the free money and the tax breaks before a single dollar goes anywhere else. So how much should you actually invest? This is where people freeze because they think there is a magic number and they are afraid of getting it wrong. There is not. Here is the honest answer. The right amount is whatever you can do consistently, starting now, without wrecking your life. A common target is around 15% of your income toward retirement, but do not let that number scare you out of starting. If 15% feels impossible today, start with 3%. Start with $50 a month. Start with the free match and nothing more. The exact amount matters far less than the habit, because you can always raise it later and you will barely feel it. In fact, here is a painless trick. Every time you get a raise, send half of it straight to investing before you get used to spending it. You never miss money you never started spending. And you do not need to wait for a big pile of cash or for the market to look calm. You just invest a steady amount on a schedule, no matter what the market is doing. When prices are high, your money buys a little less. When prices drop, that same money buys more shares on sale. Over time, this smooths out your price and takes the guesswork out completely. It is called dollar cost averaging, and it is really just a fancy name for the most powerful habit in investing. Show up every month, rain or shine, and let time do the rest. So here is exactly how you start, and I promise it is simpler than you think. Let me make this stupidly simple for steps. Step 1, open an account with a large, reputable brokerage. The big trustworthy names charge nothing to open one, have no minimum to begin, and the whole thing takes about 10 minutes on your phone. If your employer has a retirement plan with a match, start there first. Otherwise, open a Roth account to begin on your own. Step 2, put money in. Link your bank and transfer whatever you can, even $50. Getting the money into the account is the step most people freeze on. So make it small and just do it. Step 3, and this is the one almost everyone misses, actually buy the fund. This is critical. Money sitting in the account is not invested. It is just parked. You have to use it to buy a low-cost, broad market index fund. Look for a total U.S. market fund or a large market index fund with a fee called an expense ratio under about 0.1%. One good fund is genuinely enough to start with. You do not need 10. Step 4, automate the whole thing. Set up an automatic transfer every payday, so investing happens quietly in the background without you having to feel it or decide it each month. This is the secret the wealthy understand, and most people never do. Consistency beats brilliance. A boring automatic transfer every month into one simple fund, left completely alone for decades, quietly outperforms almost everyone who tries to be clever and time it. That is the entire strategy. Open, deposit, buy the fund, automate, repeat, forget. Now let me save you from the mistakes that quietly kill returns, because they get almost everyone at some point. First, trying to time the market. Waiting for the perfect dip to buy sounds smart, and it is a trap that catches even the professionals. Nobody can reliably predict the bottom. Time in the market beats timing the market every single time. The winning move is to invest steadily no matter what the headlines are screaming that week. Second, panic selling. The market will drop. It always does, and it always will. And the single most expensive thing you can do is sell in fear at the bottom, turning a temporary dip into a permanent, locked-in loss that would have recovered if you had just held on. A drop on the screen is not you losing money. It only becomes a real loss the moment you sell. The investors who win are the boring ones who do absolutely nothing during the storm. Third, chasing the exciting stuff. The meme stock everyone online is screaming about, the crypto coin your cousin swears will make him rich, the hot tip from a stranger with a nice car. That is not investing. That is gambling wearing a nicer outfit. Keep the boring index fund as your solid core, And never bet money you cannot afford to lose on a lottery ticket. And fourth, checking your account every single day. It does nothing productive. It only tempts you into an emotional mistake when the number is red. Set it, automate it, and check it maybe a couple of times a year. The people who peak the least often almost always perform the best because they let the plan work. So let us come back to where we started. You were told investing is a risky gamble meant for other people, richer people, smarter people. But now you can see the real truth. The actual gamble was standing perfectly still, letting inflation quietly drain the money you worked so hard to earn and save, while telling yourself the whole time that you were being responsible and safe. Investing was never about being smart enough to beat the market. It is about being patient enough to let a simple, boring plan quietly work in the background. You do not need to pick the perfect stock. You do not need to watch the news or refresh a chart. You do not need to already be rich to start. You need one broad index fund, a small amount you contribute automatically, and the discipline to leave it completely alone while time does the heavy lifting for you. That is not a get-rich-quick scheme. It is a get-wealthy for sure, slowly, framework that has quietly worked for ordinary people for 100 years. So here is your one move from this video. Do not try to do everything today and overwhelm yourself. Just take the very first step. Open the account. If your job has a match, claim it this week, because that is free money you are currently leaving on the table every payday. If not, open a Roth, move even a small amount in, and buy one simple index fund. Then set up an automatic transfer and walk away. Future you, decades from now, will look back at this exact moment as the day the money finally started working for you, instead of for the bank. If this made investing feel less scary and more doable, subscribe, because this whole channel is about replacing money stories with money math, one video at a time. And if you have not seen it yet, go watch the video on how your bank is quietly robbing you, because knowing where to keep your safe cash is the perfect partner to knowing how to grow the rest. The account balance was never really the goal. Freedom is. And this is exactly how you buy it, one small automatic transfer at a time. I will see you in the next one. Take care.